Here's a question that has been quietly driving people insane for decades. Every country on Earth seems to be in debt. The United States owes $34 trillion. Japan owes the equivalent of more than twice its entire annual economic output. The United Kingdom, France, Germany, Italy, Canada, Australia, all in debt. China, in debt. Brazil, in debt. Even tiny countries that you'd think would be too small to have complicated financial problems are carrying national debt loads that would make a reasonable person wince. And at some point, usually around 2 a.m., when the brain decides to ask uncomfortable questions instead of sleeping, someone realizes, if everyone is in debt, who exactly is everyone in debt to? Is there some cosmic creditor sitting in a large chair somewhere, accepting payments from the governments of the world in exchange for having lent money to all of them simultaneously? Is there a room somewhere where Greece and Argentina sit in plastic chairs next to a desk and explain why they're a little late on last month's payment? Is there a single entity, a mega bank, a shadowy organization, a particularly ambitious individual, that has somehow lent money to essentially the entire planet? The answer, it turns out, is both more mundane and more fascinating than any of those scenarios. Here's the spoiler that this entire video is going to explain in detail. Countries mostly owe money to each other, and to their own citizens, and to banks, and to pension funds, and to insurance companies, and to foreign governments, and to central banks that they themselves created and technically control, and to investors who bought bonds at a Tuesday morning auction and then went home and forgot about it. The global debt system is not a single creditor-debtor relationship. It is an extraordinarily complex web of overlapping financial obligations in which almost every participant is simultaneously a creditor and a debtor, in which the country that owes trillions also has trillions owed to it, in which the bank that holds government bonds also owes deposits to households, in which the pension fund that lends to governments owes retirement benefits to workers, in which the central bank that buys its own government's debt technically owes the currency it created to everyone who holds it. Understanding this web is not just an exercise in satisfying 2 a.m. curiosity, it is the specific analytical foundation for understanding every major financial story of the past century, every debt crisis, every bailout, every currency collapse, every inflation episode, every financial panic, because all of them are fundamentally stories about what happens when specific threads in this web are pulled too hard, too fast, or in the wrong direction. This video is going to take that web apart, thread by thread, and show you exactly what it is, who's in it, how it got this way, and why it matters, starting with the most basic question: what does it actually mean for a country to be in debt? Chapter 1. What government debt actually is, and why it's not. What you think. Here's the first thing that needs to be established before any of the rest of this video makes sense: the specific meaning of government debt, and why it is genuinely different from the debt that most people think about when they hear the word. When most people hear that someone is in debt, they picture a relatively simple relationship. A person borrowed money from a lender, they owe that money back, plus interest, and the situation is clearly bad for them and clearly good for whoever they borrowed from. The debtor is stressed, the creditor is comfortable, and the resolution involves the debtor paying the creditor until the debt is gone. Government debt does not work like this, not even slightly. Understanding why requires understanding what government bonds actually are, how they're created, who holds them, and what the relationship between the government and its creditors actually involves. What a government bond actually is. Here's the specific financial instrument that constitutes the vast majority of government debt, the bond, described plainly enough that you don't need a finance background to understand it. A government bond is a specific legal promise made by a government to pay a specific amount of money at a specific future date, with specific interest payments along the way. When the United States Treasury issues a 10-year bond with a face value of $1,000 and a 4% annual interest rate, it is making this specific promise: for the next 10 years, I will pay $40 per year to whoever holds this bond, and at the end of 10 years, I will pay $1,000 to whoever holds it then. The person or institution that buys this bond is making a specific loan. They are giving the Treasury $1,000 today in exchange for the stream of payments described. The Treasury gets the $1,000 now and uses it to fund government spending. The buyer gets the stream of interest payments and the return of principal, the specific feature that makes government bonds different from personal or corporate loans. They are tradable. The person who bought the bond at the original auction does not have to hold it until maturity. They can sell it to someone else at any time, at the market price, which may be higher or lower than the original $1,000 depending on how interest rates and market conditions have changed since the bond was issued. The bond circulates through the financial system, passing from hand to hand, being used as collateral, being pledged as security, being traded on financial markets around the world, while the underlying obligation to pay the $40 per year and the $1,000 at maturity remains with the government that issued it. This tradability is the specific feature that makes government bonds the foundation of the global financial system rather than a simple bilateral loan relationship. The bond is simultaneously a debt of the government and an asset of whoever holds it at any given moment, and the identity of who holds it changes continuously through the normal functioning of financial markets. The scale that makes government debt different. Here's the second feature that makes government debt genuinely different from individual or corporate debt: the specific scale at which governments borrow and the specific role that scale plays in the financial system. The U.S. government has approximately $27 trillion in publicly held debt, the portion of its $34 trillion total debt that is held by parties outside the U.S. government itself. This is not a large personal loan scaled up. It is the specific financial infrastructure of the world's largest economy, the pool of risk-free assets against which the entire global financial system is priced, the collateral that backs trillions of dollars of financial transactions, the safe haven that investors flee to during every global crisis, and the primary asset class of virtually every institutional investor on the planet. This scale means that government bonds serve specific functions in the financial system that no other asset can perform. They are the risk-free rate, the benchmark return against which every other investment is evaluated. They are the ultimate collateral, the specific asset that can be pledged as security for borrowing in virtually any financial context. They are the safe haven, the specific destination of capital during every period of financial stress. The U.S. Treasury market specifically is so central to the global financial system that disruptions in its functioning, as happened briefly in March 2020 during the COVID panic, produce immediate stress throughout the entire global economy. Government debt is not simply a liability of the government that issued it, it is simultaneously a critical asset of the financial system that holds it. The debt and the asset are two sides of the same instrument, and understanding this duality is the foundation of understanding who owns the debt and why. The deficit versus debt distinction. Here's the specific conceptual distinction that trips up most discussions of government debt: the difference between the deficit and the debt. The deficit is the annual shortfall between what a government spends and what it collects in revenue. In a year when the U.S. government spends $6 trillion and collects $4.5 trillion in taxes, the deficit is $1.5 trillion. The government must borrow $1.5 trillion to cover the gap by issuing $1.5 trillion in new bonds. The debt is the cumulative stock of all borrowing that has not yet been repaid, the sum total of all deficits that have been run throughout the country's history, minus any surpluses that have been used to repay debt. The U.S. federal debt of $34 trillion represents decades of accumulated deficits, the specific financial history of a government that has spent more than it collected in most years since World War II. The specific relationship between deficit and debt: the deficit is the flow, the annual addition to the debt stock. The debt is the stock, the total outstanding at any point in time. Running a smaller deficit reduces the rate at which debt grows, but does not reduce the debt itself. Actually, reducing the debt requires running a surplus, collecting more in revenue than you spend, and using the surplus to repay existing bonds. The reason this distinction matters for the "who do they owe it to" question: the annual deficit determines how much new borrowing must be placed with creditors each year, who is buying the new bonds. The total debt determines how much existing debt is held by creditors across the financial system, who holds the accumulated stock of bonds from all the previous years of borrowing. Both questions have specific answers, and they involve different sets of creditors. Chapter 2: The Domestic Creditors. Why countries mostly owe money to themselves. Here's the answer to the first and most important component of the "who do they owe it to" question: the specific domestic creditors that hold the majority of most countries' government debt, and the specific reasons why domestic creditors dominate the creditor base for most of the world's largest economies. The answer to the title question, in its simplest form, is this. Most countries owe most of their debt to their own citizens and institutions, to domestic pension funds, domestic banks, domestic insurance companies, domestic mutual funds, and in a particularly interesting category, to their own central banks. The foreign creditor story, the Japan holding U.S. treasuries, the China holding U.S. treasuries story, is real and important, but it is the minority share of most countries' debt, not the majority. The domestic institutional investors, the biggest creditors nobody talks about. Here's the specific domestic institutions that hold the largest quantities of government bonds. The pension funds, insurance companies, and mutual funds that between them own a majority of the outstanding government debt of most developed economies. Pension funds are the largest single category of domestic government bondholder in most developed economies. The specific reason is straightforward. Pension funds have specific, long-dated liabilities, the pension payments they will owe their beneficiaries over the next 20 to 40 years, and they manage those liabilities by holding assets of similar duration. Government bonds, particularly long-dated government bonds, are the specific asset class that most closely matches the duration of pension fund liabilities. The pension fund that needs to pay a retired teacher her pension in 2045 finds that a 20-year government bond maturing in 2045 is the specific asset that most directly matches that obligation. The scale of pension fund government bond holdings globally is extraordinary. U.S. public and private pension funds collectively hold approximately $3 trillion to $4 trillion in U.S. Treasury bonds, representing approximately 12% to 15% of the total publicly held U.S. debt. Japanese pension funds, led by the Government Pension Investment Fund with its $1.5 trillion in assets, hold enormous quantities of Japanese government bonds. European pension funds, particularly in the Netherlands, the United Kingdom, and the Nordic countries, are the largest single holders of their respective government's debt. When the question, who does the government owe money to, is asked about the United States, the honest first answer is pensioners. Not directly. The pensioners don't hold the bonds themselves, but the pension funds that hold the bonds hold them on behalf of the workers who will eventually receive the pension payments that the investment returns fund. The government's debt obligation flows through the pension fund to the ultimate beneficiary, the retired firefighter, the retired teacher, the retired factory worker whose monthly pension payment is funded in part by the interest payments on the government bonds their pension fund holds. Insurance companies are the second major category of domestic institutional holder. Life insurance companies in particular, which manage long-dated liabilities in the form of the death benefits and annuity payments they have promised to policyholders, hold enormous quantities of government bonds for the same duration matching reason as pension funds. The life insurance company that sold a 40-year annuity to a policyholder in 2000 needs assets that will still be generating returns in 2040. And long-dated government bonds are the specific asset class that meets this requirement. Mutual funds and exchange-traded funds, the vehicles through which retail investors invest their savings, collectively hold substantial quantities of government bonds, both directly through bond funds and indirectly through the balanced and target date funds that combine equity and bond exposure. The individual investor who holds a target date retirement fund in their 401k is an indirect holder of government bonds. The fund's bond allocation owns the bonds on their behalf. The commercial banking system, the government's most intimate financial relationship. Here's the second category of domestic creditors, the commercial banking system, and the specific intimate financial relationship between governments and the banks that operate in their economies. Commercial banks, the institutions that take deposits and make loans, are major holders of government bonds in most countries. The specific reasons are both regulatory and financial. Regulatory, banking regulations in most countries require banks to hold a specific quantity of high-quality liquid assets that can be converted to cash quickly during periods of stress. And government bonds are the specific assets that regulators most universally recognize as meeting this requirement. Financial. Government bonds provide the specific combination of safety, liquidity, and yield that makes them attractive for the portion of a bank's balance sheet that needs to be safe and accessible. The regulatory requirement to hold high-quality liquid assets, formalized in the Basel III regulatory framework following the 2008 financial crisis, has made government bonds a mandatory component of commercial bank balance sheets globally. Every major bank in the world holds government bonds as part of its required regulatory capital buffer. The aggregate holdings of the global commercial banking system represent a significant fraction of total government debt outstanding in most developed economies. The specific intimacy of the bank-government financial relationship goes beyond bond holdings. Governments regulate banks. Banks hold government bonds. Governments provide deposit insurance that backs bank deposits. Banks create the money supply that circulates in the economy and generates the tax revenue that the government collects. Banks participate in government bond auctions as primary dealers, providing the specific market-making function that allows the government to sell its bonds to the public. The relationship is circular, codependent, and in specific stress scenarios, the 2008 financial crisis, the 2010 to 2012 European sovereign debt crisis, mutually reinforcing in ways that can amplify rather than stabilize financial stress. The central bank, the creditor the government created itself. Here's the most philosophically interesting category of domestic creditor, the central bank, which is a specific institution that the government technically created, that holds an extraordinary quantity of the government's debt, and that creates the specific conceptual puzzle of what it means to owe money to an institution that is itself a creation of the state. The Federal Reserve and the United States Central Bank currently holds approximately $5 trillion in U.S. Treasury bonds. This holding, the result of the quantitative easing programs deployed during the 2008 financial crisis, the 2020 COVID crisis, and the economic weakness of the 2010s, makes the Federal Reserve one of the single largest holders of U.S. government debt. The Treasury owes the Federal Reserve approximately $5 trillion in principal and interest payments. The specific conceptual puzzle, the Federal Reserve was created by the U.S. government. Its Board of Governors is appointed by the President and confirmed by the Senate. Its profits, the interest it earns on its Treasury bond holdings minus operating expenses, are remitted to the U.S. Treasury annually. In 2021, the Federal Reserve remitted approximately $107 billion to the U.S. Treasury, money that the Treasury had paid in interest on the bonds the Fed held, flowing back to the Treasury as the Fed's annual profit payment. So the government owes money to the central bank earns interest on that money, and then the central bank gives most of the interest back to the government. The government is, in a specific sense, paying interest to itself. The net cost of the debt held by the Federal Reserve is the operating costs of the Federal Reserve itself, not the full interest payments. This circular arrangement is the specific financial mechanism that makes the government owes money to its central bank a fundamentally different kind of debt from the government owes money to a Japanese pension fund. The central bank holding is an intra-governmental accounting arrangement, economically significant in its effects on the money supply and financial conditions, but not the kind of debt that creates a genuine external claim on the government's resources. The specific caveat that prevents this from being a perpetual free lunch when the central bank creates the money to buy the government bonds, as it does through quantitative easing, it is expanding the money supply. Expanding the money supply, if done excessively, produces inflation. The inflation is the specific cost that the government ultimately pays for the debt monetization that central bank bond buying represents. The inflation is distributed across the entire economy rather than appearing in a government budget line, but it is the genuine cost of the monetary financing of government deficits. Chapter 3. The Foreign Creditors. Who actually owns everyone else's debt? Here's the chapter that addresses the foreign creditor side of the equation, the specific foreign institutions and governments that hold the significant minority share of most countries' government debt that is owned by parties outside the issuing country. The foreign creditor story is the more dramatic part of the government debt narrative. The Japan holding U.S. treasuries, the China reducing its treasury holdings, the developing countries borrowing from the IMF, the Caribbean nations owing Chinese infrastructure loans, and it is the part of the story that most financial news coverage focuses on, but understanding it accurately requires understanding both who the foreign creditors are and why the foreign creditor share is typically smaller than public discourse implies. Foreign central banks, the world's most boring portfolio managers. Here's the largest category of foreign government creditor, the foreign central banks that hold U.S. Treasury bonds and other developed country government bonds as their foreign exchange reserves. Foreign exchange reserves are the specific pool of foreign currency denominated assets that a country's central bank holds to manage its currency's exchange rate and to provide a financial cushion against external shocks. When a country's currency comes under pressure, when investors are selling the local currency and buying foreign currency, the central bank can sell its foreign reserves to buy the local currency, supporting its value. When a country needs to make foreign currency payments, to service external debt, to pay for critical imports, the central bank can use its reserves rather than forcing the currency to depreciate. The world's foreign exchange reserves total approximately $12 trillion, of which approximately 58% to 60% is held in US dollars, meaning approximately $7 trillion of the world's foreign exchange reserves is in dollar-denominated assets, primarily US Treasury bonds. This is the specific mechanism through which the dollar's reserve currency status translates into persistent foreign central bank demand for US government debt. The dollar's role as the world's primary reserve currency means that every country that accumulates foreign reserves is accumulating mainly dollar assets, and the most attractive dollar assets available in the required quantity and quality are U.S. Treasury bonds, the specific foreign central banks with the largest dollar reserve holdings. China's People's Bank of China holds approximately $3.2 trillion in total foreign reserves, of which the dollar share is approximately $780 billion in U.S. Treasury bonds. Japan's Ministry of Finance holds approximately $1.25 trillion in foreign reserves, of which a significant fraction is in U.S. Treasuries. Saudi Arabia, the UAE, South Korea, Taiwan, Singapore, India, Brazil all hold substantial dollar reserves, primarily in U.S. Treasuries, as part of their foreign exchange reserve management. The specific reason these holdings are the most stable component of foreign creditor demand, foreign central banks hold treasuries as reserve assets, for the specific functions of currency management and external payment capacity, not as a yield optimization strategy. Their decision to hold or reduce treasuries is driven by their reserve management needs rather than by yield differentials, making them more stable holders than yield-seeking institutional investors. Foreign governments lending to each other, the bilateral debt web. Here's the second category of foreign creditors, the specific bilateral government-to-government lending relationships that have proliferated over the past few decades, creating a web of direct financial obligations between specific countries. The most extensive bilateral government lending program currently operating is China's Belt and Road Initiative, the specific program through which the Chinese government and Chinese state-owned banks have lent approximately $1 trillion to approximately 150 countries for infrastructure development since its formal launch in 2013. The recipients are primarily developing economies in Asia, Africa, Latin America, and Eastern Europe, countries whose infrastructure needs exceeded their domestic financial capacity and whose access to Western capital markets was limited. The Belt and Road lending has created specific bilateral debt relationships that have proven problematic in specific cases. The specific scenario where a developing country borrowed to build infrastructure whose revenue-generating capacity was insufficient to service the debt, leading to debt distress and the specific renegotiations that have characterized several high-profile BRI debt situations. Sri Lanka's Hambantota port, the specific case where Chinese infrastructure debt led to the port being leased to a Chinese company for 99 years, became the emblematic example of what critics call debt trap diplomacy, though the specific circumstances of each case vary considerably. The United States' bilateral lending programs operate primarily through the Export-Import Bank, the Development Finance Corporation, and multilateral institutions like the World Bank and the International Monetary Fund, where the U.S. is the largest shareholder. These programs create specific bilateral financial relationships where the U.S. government or U.S.-backed institutions are creditors to developing country governments. The specific bilateral debt relationships among developed countries are less dramatic but financially significant. The European Stability Mechanism lending to Greece, Spain, Portugal, and Ireland during the 2010 to 2012 sovereign debt crisis created specific bilateral or multilateral creditor relationships within the Eurozone that have their own specific repayment dynamics and political consequences. international financial institutions, the multilateral creditors. Here's the third category of foreign creditors: the specific multilateral financial institutions that pool capital from multiple member countries and lend it to specific borrowers, creating a particular type of creditor relationship that is different from both central bank reserve holdings and bilateral government lending. The International Monetary Fund is the specific multilateral institution that lends to countries experiencing balance of payments crises, situations where a country cannot make its external payments because it has run out of foreign exchange reserves or has lost access to international capital markets. The IMF's lending programs typically come with specific policy conditions: the structural adjustment programs that require fiscal consolidation, monetary tightening, and economic liberalization in exchange for the emergency financing that have made the IMF one of the most politically contentious creditors in the world. The IMF's resources come from the quotas that member countries contribute, the specific financial assessments based on each country's size in the global economy. The United States, as the largest IMF shareholder with approximately 17% of voting power, is effectively the largest contributor to the fund that lends to distressed sovereigns. The U.S. is simultaneously a significant creditor. Through the IMF, its quota contribution provides the capital, and not directly a creditor to the IMF's borrowers, since the IMF is a separate legal entity. The World Bank and its affiliated institutions, the International Development Association, the International Finance Corporation, provide development financing to lower-income countries at concessional rates. The World Bank's lending programs are specifically for development projects, the infrastructure, education, and health investments that developing countries need but cannot finance through commercial capital markets. The World Bank's resources come from the bonds it issues in global capital markets, bonds that are themselves backed by the capital and guarantees of its member countries, and from member country contributions to its concessional lending windows. The private foreign investors, the market participants, nobody mentions. Here's the fourth category of foreign creditors: the private. Foreign investors who hold government bonds as part of their investment portfolios, and the specific mechanism through which private capital flows from one country's investors into another country's government bonds. The private foreign investor category includes hedge funds that trade government bonds across borders as part of their investment strategies, sovereign wealth funds, the state-owned investment vehicles of countries like Norway, Singapore, and the Gulf states, that invest the excess savings of their respective economies in diversified global portfolios that include foreign government bonds, foreign mutual funds, and ETFs that provide their investors with international fixed income exposure, foreign insurance companies and pension funds that hold foreign government bonds as part of their asset liability management. The specific mechanism through which private foreign capital flows into government bonds. The global fixed income market is a genuinely global market. Investors in Tokyo, London, Zurich, and Singapore buy and sell U.S. Treasury bonds, German bonds, and Japanese government bonds in the normal course of their portfolio management. The yield differential between different countries' government bonds, combined with currency expectations, drives the allocation of private foreign capital across the global bond market. This private foreign investor category is the most volatile component of foreign creditor demand, the most responsive to yield differentials, currency movements, geopolitical developments, and general risk appetite. When the environment for holding a particular country's bonds deteriorates, because yields are too low, because currency risk has increased, because political uncertainty has risen, private foreign investors adjust their allocations much faster than foreign central banks or multilateral institutions. The volatility of private foreign investor demand is the specific source of the bond market. Instability that can translate economic deterioration into financial crisis when foreign investor confidence breaks. Chapter 4: The Circular Nature of Global Debt. Why everyone owes everyone. Here's the chapter that addresses the specific conceptual puzzle at the heart of the global debt question, the specific reason that the answer to who do countries owe money to is so often each other, and why this circularity is not a paradox that needs to be resolved but a fundamental feature of how the modern financial system is designed to work. The circularity of global debt is not accidental. It is the specific product of a financial architecture that was deliberately constructed after World War II to create the interdependencies that the architects believed would make future wars economically irrational. Whether that specific ambition succeeded is a different question. What unambiguously succeeded is the creation of a financial system in which practically every major economy is simultaneously a significant creditor and a significant debtor, in which the web of mutual obligation is so dense that the complete financial isolation of any single major economy would damage every other major economy through the specific channels of lost trade, lost investment, and lost financial market functioning. The bilateral symmetry, how every debt relationship is actually two-way. Here's the specific mechanism that produces the bilateral symmetry in debt relationships, the specific reason that most lending relationships between countries exist in both directions simultaneously rather than as simple one-way flows from creditor to debtor. Consider the US-Japan financial relationship from the previous section. Japan holds approximately $1.1 trillion in US Treasury bonds. Japan is a creditor to the United States in this specific relationship. But the United States has direct investment in Japan of approximately $700 billion. U.S. companies have built factories, acquired businesses, and invested in Japan, creating a financial claim on Japanese productive assets. The U.S. is a creditor to Japan through this investment relationship. Simultaneously, Japan has direct investment in the United States. Japanese car manufacturers have built assembly plants in the American South. Japanese financial companies have acquired U.S. financial institutions, creating Japanese creditor claims on American productive assets. The net financial position between the U.S. and Japan, who owes more to whom when all financial relationships are aggregated, is considerably less dramatic than the headline number of Japan holding $1.1 trillion in U.S. bonds suggests. The bilateral financial relationship is genuinely two-way, with flows in both directions creating mutual financial stakes in each other's economic stability. This bilateral symmetry characterizes virtually every major creditor-debtor relationship between developed economies. Germany is a net creditor to most of Southern Europe. German banks, insurance companies, and pension funds hold substantial quantities of Italian, Spanish, and Greek bonds. But Italy is a significant investor in Germany. Italian capital has flowed into German real estate, German business equity, and German financial instruments. The net creditor-debtor relationship between Germany and Italy exists, but it is much smaller than the gross financial flows in either direction. The gross versus net distinction, the accounting, that changes everything. Here's the specific accounting distinction that most discussions of international debt get wrong, the difference between gross debt and net debt positions, and why the gross numbers that dominate headlines are the less economically meaningful of the two. Gross debt is the total amount a country owes, all of its outstanding financial obligations to all creditors, domestic and foreign. The United States' gross government debt of $34 trillion is a gross figure. It counts every treasury bond outstanding regardless of who holds it. Net debt is the total amount a country owes minus the total amount owed to it, the balance of financial obligations after netting out the creditor and debtor positions. The United States' net international investment position, the difference between what U.S. entities own abroad and what foreign entities own in the U.S., is approximately negative $18 trillion, meaning the U.S. has approximately $18 trillion more in foreign financial claims against it than it has claims on foreigners. But even this net position overstates the specific vulnerability it might appear to imply because of the specific composition of the assets and liabilities. The United States' foreign liabilities are predominantly in dollars, the treasury bonds and other dollar assets that foreigners hold. The United States' foreign assets are predominantly in foreign currencies, the equity investments, factories, and financial claims that U.S. entities have in foreign countries. When the dollar weakens, the dollar value of the U.S. foreign assets increases while the burden of the dollar-denominated foreign liabilities stays constant, meaning dollar weakness actually improves the U.S. net international investment position. This specific asymmetry in the currency composition of assets and liabilities is the specific reason the U.S. net debtor position is less concerning than it appears in headline numbers. The daisy chain, how debt creates more debt. Here's the specific mechanism through which the global debt system has expanded over time, the specific way in which one financial transaction creates the conditions for multiple additional financial transactions, producing the daisy chain of debt that has resulted in the total global debt of approximately $300 trillion that exists today. The daisy chain operates through the specific mechanism of money creation in the modern banking system. When a government issues bonds, the banks that buy those bonds use them as collateral to borrow additional funds from the central bank or from other banks. The additional funds are then lent to businesses and households. Those businesses and households use the borrowed funds to make purchases that generate revenue for other businesses that deposit the revenue in banks. The banks use the deposits to make additional loans. Each link in the chain creates new financial obligations, new debt. While the original debt that started the chain remains outstanding, the total global debt of approximately $300 trillion, government debt, corporate debt, household debt, financial sector debt aggregated across all economies, is the specific cumulative result of this daisy chain operating across the global economy for decades. The ratio of total debt to global GDP, currently approximately 340%, reflects the specific extent to which the financial system has amplified the original economic output through the multiplication of credit. This debt multiplication is not purely negative. The credit creation that expands the total debt stock also expands the productive capacity of the economy, funds the investments that generate future income, and provides the financial lubrication that allows the complex specialization of the modern economy to function. But it does create the specific systemic vulnerability that comes from the density of the obligation web. The vulnerability, where a stress in one part of the system propagates through the daisy chain to affect every connected part. The netting problem, why you can't just cancel it all out. Here's the specific reason that the obvious solution to the everyone owes everyone problem, why don't all the countries just cancel out their mutual debts and start fresh, is not actually as simple as it sounds. The intuitive appeal of the cancellation idea is genuine. If the US owes Japan $1.1 trillion and Japan has US investments worth $700 billion, why not net out the $700 billion and have the US owe Japan only $400 billion? If Germany owes Italy some amount and Italy owes Germany some amount, why not just find the net and settle for that? The specific practical obstacles to this netting are multiple and serious. First, the individual holders of the claims are different entities. The $1.1 trillion that Japan holds in U.S. treasuries is not held by the Japanese government. It is held by Japanese pension funds, life insurance companies, banks, and the Ministry of Finance through its foreign exchange reserve account. The $700 billion in U.S. direct investment in Japan is not held by the U.S. government. It is held by Ford, Goldman Sachs, Google Japan, and thousands of other U.S. private entities. Netting out obligations between these different legal entities, transferring the claims and obligations from private parties to the government to facilitate a government-level netting, would require the specific expropriation of private financial assets that no market economy can execute without destroying the property rights that make investment possible in the first place. Second, the assets and liabilities have different characters. A U.S. Treasury bond is a liquid, tradable, dollar-denominated promise to pay a specific cash amount at a specific date. A U.S. company's factory in Japan is an illiquid, non-tradable, yen-denominated productive asset whose value is uncertain and whose conversion to a cash amount for netting purposes would require a specific valuation that nobody could agree on. Third, the financial system depends on the specific circulation of debt instruments. Treasury bonds are not merely debt, they are collateral, they are reserve assets, they are the benchmarks against which every other financial asset is priced. Canceling them out would destroy the specific financial infrastructure they provide, not merely eliminate a bilateral financial obligation. The circularity of global debt is therefore not a problem that can be solved by netting. It is the specific architecture of the financial system that makes it function. Chapter 5. The Historical Origins. How the world got into this much debt. Here's the chapter that answers the specific historical question that naturally follows from understanding the current structure of global debt. How did this happen? The $300 trillion in global debt, the $34 trillion in U.S. government debt, the 260% of GDP in Japanese debt. None of this existed before the modern era. How did the world accumulate this much financial obligation? The answer is a specific historical narrative that involves wars, economic crises, the abandonment of the gold standard, the development of central banking, the innovation of deficit spending as a legitimate policy tool, and the specific political economy of democratic governments that find it much easier to borrow than to tax. The gold standard era, when debt had a real anchor. Here's the specific historical context that most clearly illustrates how different the pre-modern debt world was from the current one. The gold standard era, when government debt was constrained by the specific physical requirement that every unit of currency could be converted to a specific quantity of gold. Under the gold standard, which operated in various forms for most major economies from the late 19th century until its final collapse in 1971, governments could not simply create unlimited debt. The currency in which the debt was denominated could be redeemed for gold at a fixed price, which meant the total currency outstanding was constrained by the gold reserves held by the central bank. A government that issued too much debt and created too much currency risked a run on its gold reserves, investors demanding the gold that the currency was supposed to represent, that would force an embarrassing and economically damaging devaluation or default. This gold constraint kept government debt levels relatively modest by modern standards. The United States debt to GDP ratio in 1900 was approximately 14%. Most European governments were similarly constrained. The specific mechanism was brutal in its simplicity. If you couldn't pay your debts in gold, you defaulted, your currency was devalued, and your creditors suffered the specific consequences of having lent to an overextended borrower. The gold standard was not without its own specific pathologies. It contributed to the specific deflationary spirals that turned recessions into depressions by preventing the monetary expansion that could have stabilized demand, but it provided the specific external discipline on government borrowing that modern fiat currency systems lack. The wars, the specific events that broke the debt ceiling. Here's the specific historical event that produced the first dramatic break in the gold standard. Constraint and the first dramatic expansion of government debt beyond what the pre-war financial architecture would have permitted. The First World War and its financial consequences. The First World War required the combatant nations to mobilize resources on a scale that utterly overwhelmed the capacity of taxation to finance. The war was expensive beyond any previous experience of government expenditure, and it required borrowing at a scale and speed that the gold standard's constraints on currency creation made impossible without explicit or de facto abandonment of convertibility. Britain, France, Germany, and all the other major combatants suspended gold convertibility at the outbreak of war and began the specific process of creating money and issuing debt at unprecedented rates to fund military expenditure. The United States, when it entered the war in 1917, financed its participation through the specific Liberty Bond campaigns that mobilized domestic savings on a massive scale, the specific moment when ordinary American households became creditors to the U.S. government through mass bond purchases. The war debt left Europe with debt levels that were genuinely difficult to service, particularly Germany, which had the additional burden of war reparations imposed by the Treaty of Versailles. The specific attempt to restore the gold standard in the 1920s, at the pre-war parities that were no longer consistent with the post-war price levels, produced the deflationary pressures that contributed to the Great Depression. The specific failure of the interwar gold standard restoration is one of the clearest examples in economic history of the costs of trying to restore a nominal anchor that the war had permanently destroyed. The Second World War produced an even more dramatic expansion of government debt. The United States financed World War II through a combination of extraordinary taxation. The top marginal income tax rate reached 94% during the war, and extraordinary borrowing. The U.S. debt-to-GDP ratio reached approximately 120% at its peak in 1946, the highest in American history. The United Kingdom's debt-to-GDP ratio exceeded 250% at the war's end. These were not normal peacetime levels. They were the specific financial legacy of a global conflict whose cost was borne partly by current taxpayers and partly by future generations through the debt issuance that funded the war. The Bretton Woods Settlement, the architecture that created modern government debt. Here's the specific post-war institutional arrangement that created the modern framework for government borrowing. The Bretton Woods system, established in 1944, that defined the international monetary order for the subsequent quarter century and whose legacy shapes the current debt structure. The Bretton Woods Conference of 1944 established a specific international monetary architecture. The US dollar was pegged to gold at $35 per ounce, and all other major currencies were pegged to the dollar. The International Monetary Fund was created to provide emergency financing to countries experiencing balance of payments difficulties. The World Bank was created to provide development financing for the reconstruction of war-damaged economies and the development of newly independent countries. The specific consequence for government debt, the dollar's special role as the anchor of the Bretton Woods system, created the persistent demand for dollar assets, primarily U.S. Treasury bonds, that has characterized the global financial system ever since. Countries accumulating dollar reserves to manage their exchange rates within the Bretton Woods system needed a safe, liquid place to hold those dollars, and U.S. Treasury bonds were the specific asset that met this requirement. The 1971 break, when the anchor was finally cut. Here's the specific historical event that removed the last external constraint on government debt. Creation, the Nixon shock of August 1971, when President Nixon unilaterally ended the convertibility of the dollar into gold, effectively ending the Bretton Woods system and transitioning the world to the pure fiat currency system that operates today. The specific reason for the Nixon shock, the United States had been running persistent fiscal deficits to finance both the Vietnam War and the Great Society social programs of the Johnson era, creating more dollars than the U.S. gold reserves could support at the $35 per ounce parity. Foreign governments, particularly France under de Gaulle, which was suspicious of American fiscal policy, had been exercising their Bretton Woods right to convert their dollar holdings to gold, draining the U.S. gold reserves. Nixon faced the specific choice of either accepting a dramatic and humiliating dollar devaluation within the Bretton Woods framework or unilaterally abandoning the framework entirely. He chose the latter. On August 15, 1971, Nixon announced that the United States would no longer convert dollars to gold, ending the specific link between the dollar and a physical commodity that had constrained currency creation and, through that constraint, limited the scale of sustainable government debt. The world that emerged from the Nixon shock was a pure fiat currency world, a world in which the dollar and the currencies pegged to or floating against it were backed not by gold, but by the specific combination of the productive capacity of the issuing economy, the credibility of the issuing government, and the institutional arrangements, particularly the Federal Reserve's inflation mandate, that were supposed to prevent the unlimited money creation that the removed gold constraint had previously made impossible. The removal of the gold constraint was the specific moment when the theoretical limit on government debt became a practical political limit rather than an automatic mechanical one. Governments could now borrow as much as markets were willing to lend them, limited only by the inflation that excessive money creation would produce and the interest rates that excessive borrowing would drive. The subsequent decades produced the specific debt expansion that has resulted in the current $300 trillion global debt stock, the cumulative result of governments consistently finding that borrowing was politically easier than taxing, and that the market's willingness to lend was greater than the discipline of any rule-based constraint on borrowing. The deficit spending revolution, Keynes and the legitimization of borrowing. Here's the specific intellectual development that provided the justification for the dramatic expansion of government borrowing. The Keynesian revolution in economic thinking that legitimized deficit spending as not merely acceptable, but actively desirable in specific economic circumstances. John Maynard Keynes's theoretical framework, developed in response to the Great Depression of the 1930s and formalized in his 1936 general theory, argued that government deficit spending was the specific tool required to stimulate aggregate demand during recessions when the private sector's reduced spending threatened to trap the economy in a prolonged depression. The government should borrow and spend during downturns, Keynes argued, and repay the borrowing during the subsequent recoveries when tax revenues were strong. The specific political appeal of Keynes was enormous. He provided an intellectually respectable justification for the specific political preference that democratic governments naturally have for spending more than they collect in taxes. The spending is visible, produces identifiable benefits for specific constituencies, and generates gratitude. The taxation required to finance it is painful, visible, and generates resentment. The borrowing that bridges the gap between spending and taxation is invisible to most people, defers the cost to future periods, and generates neither immediate gratitude nor immediate resentment. The specific Keynesian implication that proved most durable in practice, the borrowing during recessions that Keynes prescribed, the repayment during recoveries that Keynes assumed, the part of the framework that required fiscal restraint when times were good, proved politically much harder to execute. Democratic governments were excellent at the deficit spending part of the Keynesian cycle and consistently failed to execute the surplus accumulation part. The result was the specific ratchet effect in government debt expanding during recessions and not contracting during expansions, that has produced the cumulative debt levels of the modern era. Chapter 6. The Debt Crisis Mechanism. What happens when the system breaks down? Here's the chapter that addresses the specific thing that most people actually want to understand when they ask about government debt. What happens when it goes wrong? How does a country that owes too much money experience the specific financial crisis that excessive debt can produce? Who gets hurt? How badly? And through what specific mechanism does the abstract number of too much debt translate into the concrete human experience of economic disruption? Understanding the debt crisis mechanism is essential to understanding the global debt question because debt crises are the specific events that make the structure of the debt system visible. When the debt is being accumulated and serviced normally, the web of obligations is invisible to most people. When it breaks down, the specific architecture becomes visible and consequential in ways that affect every household in the affected economy. The basic debt crisis mechanism, the run on confidence. Here's the specific mechanism through which a government debt crisis typically develops, the sequence of events that converts an unsustainable debt trajectory into an acute financial crisis. Government debt crises are fundamentally confidence crises. A government that owes money to creditors can service that debt as long as two conditions are met. It has access to new borrowing at interest rates it can afford, and its economy generates sufficient tax revenue to service the debt. The specific vulnerability is the confidence feedback loop. A government that loses creditor confidence faces higher interest rates, which increases the debt service cost, which worsens the fiscal position, which further reduces creditor confidence, which drives interest rates higher still. The specific trigger that initiates this confidence feedback loop varies by crisis: an unexpectedly large fiscal deficit revelation, a sudden growth slowdown that reduces tax revenue, a political development that raises questions about the government's commitment to debt service, an external shock that produces capital flight from the currency. But the mechanism that converts the trigger into a crisis is always the same. Creditors lose confidence, demand higher yields to compensate for the perceived risk. The higher yields increase the debt service cost beyond what the government's revenue can support, and the government is faced with the specific choice of defaulting, drastically cutting other spending to service the debt, or finding a lender of last resort. The sovereign default. What it actually means. Here's the specific event that represents the most extreme version of the government debt crisis, the sovereign default, and what it actually means for the government, for its creditors, and for the economy. A sovereign default occurs when a government fails to make a required payment on its debt obligations, either failing to pay the principal at maturity, failing to make an interest payment, or unilaterally changing the terms of the debt in ways that reduce the value of what creditors receive. The specific forms of default range from the outright cessation of payments, as Argentina has done multiple times, to the haircut restructuring where creditors agree to accept less than the full face value of their claims in exchange for a new, more sustainable debt structure. The specific consequences of sovereign default for the defaulting government: loss of access to international capital markets at normal rates. The government that has defaulted must pay a significant premium if it can borrow at all for a period that typically lasts several years after the default. The domestic banking system, which holds government bonds as key assets, experiences a specific reduction in its asset values that can trigger bank failures if the bond write-downs are large enough. The currency typically depreciates sharply as foreign investors exit. For creditors, the specific consequences depend on who holds the debt. Foreign private creditors, the holders of bonds in international capital markets, experience specific losses on the market value of their holdings and may receive reduced payments through the restructuring process. Domestic pension funds and banks holding government bonds experience balance sheet impairment that threatens their ability to meet their own obligations, the specific mechanism through which the government debt crisis spreads to the domestic financial system. The European sovereign debt crisis, the case study that explains everything. Here's the specific historical case that most clearly illustrates the debt crisis mechanism in a modern developed economy context. The European sovereign debt crisis of 2010 to 2012 that threatened the existence of the euro and produced the most dramatic government bond market stress of the modern era. The European sovereign debt crisis began in Greece, where a new government revealed in 2009 that the country's fiscal deficit was dramatically larger than previously reported. Approximately 12.7% of GDP rather than the 3.7% that previous reports had indicated. The specific revelation destroyed investor confidence in Greek government finances, producing the specific confidence feedback loop described above. Greek bond yields rose sharply, increasing the debt service cost, worsening the fiscal position, raising yields further. The crisis spread from Greece to Ireland, whose government had taken on the debts of its banking system during the 2008 financial crisis, creating a sovereign debt burden that was itself unsustainable, and then to Portugal, Spain, and Italy. The specific contagion mechanism was the common currency. All of these countries used the euro, which meant they could not use the traditional sovereign debt crisis resolution tool of currency devaluation. Unable to devalue, they faced the specific choice between fiscal austerity, dramatic spending cuts and tax increases to restore creditor confidence, and the external assistance of the Eurozone's bailout mechanisms. The specific resolution of the European debt crisis involved the particular combination of IMF and European bailout loans for Greece, Ireland, and Portugal, the specific bank restructuring and ESM bailout for Spain's banking system, and the extraordinary commitment by the European Central Bank under Mario Draghi to do whatever it takes to preserve the euro, a commitment backed by the outright monetary transactions program that promised unlimited ECB purchases of sovereign bonds of distressed Eurozone members. The whatever it takes commitment was the specific intervention that ended the acute phase of the crisis. By making the ECB the implicit backstop for Eurozone sovereign debt, Draghi removed the specific tail risk of euro breakup that had been driving the confidence crisis. The commitment worked precisely because it was unlimited. The ECB's capacity to create euros is infinite, which means a commitment to unlimited bond purchases is a genuine commitment that no amount of market selling can overwhelm. The inflation resolution, when countries inflate away their debts. Here's the specific alternative to default that governments with debt denominated in their own currency can pursue: the inflation resolution that deliberately or inadvertently reduces the real value of the debt through price increases that make the nominal debt burden smaller relative to the economy's ability to service it. Inflation reduces the real burden of nominal government debt through a specific mechanism. If a government owes $1 trillion in nominal terms and inflation is 10% per year, the real value of that debt, measured in what the money can buy, falls by 10% per year without any nominal reduction in the debt balance. If wages and GDP grow at the nominal inflation rate, the tax revenues that service the debt also grow, making the debt easier to service even though its nominal level hasn't changed. This inflation resolution is the specific mechanism through which most of the dramatic debt buildups of the 20th century were ultimately resolved. The United States World War II debt of 120% of GDP was reduced to approximately 35% of GDP by the 1970s, not primarily through budget surpluses, but through the specific combination of the post-war economic expansion and the moderate inflation that reduced the real value of the nominally fixed debt while growing the GDP relative to which the debt was measured. The specific limitation of the inflation resolution: it is only available to governments that owe debt denominated in their own currency. A government that owes debt in a foreign currency cannot inflate it away, because inflation in the domestic currency simply produces currency depreciation that makes the foreign currency debt more expensive in domestic currency terms. Greece, which owed debt denominated in euros it could not create, could not use the inflation resolution, which is the specific reason the European sovereign debt crisis was so severe. The United States, which owes debt denominated in dollars it creates, can always use the inflation resolution, which is the specific reason the United States cannot truly default on its debt in the conventional sense, though it can produce the equivalent of default through inflation. The debt restructuring process, how countries renegotiate with their creditors. Here's the specific process through which governments that cannot service their debt negotiate with their creditors to modify the terms of the obligation. The debt restructuring, that is the alternative to outright default, and the typical resolution of sovereign debt crises. Debt restructuring involves the specific negotiation between the government and its creditors to modify the debt terms, extending the maturity, reducing the interest rate, or reducing the principal, in ways that make the debt sustainable while giving creditors more than they would receive in an outright default. The negotiation is complicated by the specific collective action problem of sovereign debt. When a government has thousands of bondholders scattered across the global financial system, getting all of them to agree to modified terms requires the specific legal mechanisms, collective action clauses, exchange offers, holdout creditor negotiations, that have evolved over decades of sovereign debt restructuring experience. The most complex recent sovereign debt restructuring was Greece's 2012 restructuring, the largest sovereign debt restructuring in history to that point, involving approximately 200 billion euros in debt held by private creditors and a haircut of approximately 53.5% on the nominal value of the debt. The restructuring was complicated by the specific distinction between the debt held by private creditors, which was restructured, and the debt held by the ECB and official sector creditors, which was not, reflecting the specific political and legal complications of restructuring debt held by public institutions. Chapter 7. The Developing World Debt Problem, the Most Consequential Crisis. Nobody is talking about. Here's the chapter that addresses the specific dimension of the global debt question that receives the least proportional attention relative to its human consequences. The debt situation of the world's developing economies, where the specific combination of foreign currency debt, commodity-dependent revenues, limited institutional capacity, and restricted capital market access creates debt vulnerabilities that are categorically more dangerous than the equivalent debt levels in developed economies. The developing world debt problem is not a new phenomenon. Sovereign debt crises in Latin America, Africa, and Asia have been a recurring feature of the global financial landscape for centuries. But the current episode has specific characteristics that distinguish it from previous cycles, and that make it the specific global financial story most likely to produce the human consequences, poverty, economic reversal, political instability, that the academic language of sovereign debt distress sanitizes beyond recognition. The scale of the current developing world debt crisis. Here's the specific data that establishes the scale of the current developing world debt problem. The numbers that most financial news coverage underreports because developing country debt crises are slower moving and less visually dramatic than the bank runs and currency crashes of developed economy crises. As of recent assessments, approximately 60% of low-income countries are in or at high risk of debt distress, the specific technical term for the situation where a country's debt burden exceeds its capacity to service it without significant economic sacrifice. The World Bank and IMF jointly classify countries as in debt distress when they are already in default or restructuring, and as at high risk when the debt trajectory makes distress highly likely within the medium term. The countries currently in active debt distress or restructuring include Sri Lanka, which experienced the most dramatic and most visible crisis of the recent cycle, with public protests forcing a presidential resignation, severe shortages of fuel and medicines, and the specific economic collapse that comes from a country losing access to the foreign currency it needs to import essential goods. Ghana, the West African economy that had been celebrated as a development success story, and that is now in IMF-assisted restructuring. Zambia, the first African country to default during the COVID period. Ethiopia, wrestling with debt restructuring complicated by the specific challenge of negotiating simultaneously with Chinese creditors, Western creditors, and the Euro bond holders who play by different rules than bilateral official creditors. The broader category of countries at high risk of distress includes a significant fraction of sub-Saharan Africa, several South Asian economies, and specific Latin American countries where the combination of commodity price volatility, fiscal deficits, and dollar-denominated debt creates the specific vulnerability that the debt crisis mechanism described in Chapter 6 exploits, the foreign currency debt problem, the trap that developing countries can't escape. Here's the specific technical feature of developing country debt that makes it categorically more dangerous than equivalent debt levels in developed economies: the foreign currency denomination of much of their debt, particularly the hard currency debt that developing countries issue in international capital markets. When the United States government issues debt, it issues bonds denominated in US dollars, the currency that the US Federal Reserve creates. If the US faces a debt crisis, it has the specific option of instructing the Federal Reserve to create dollars and purchase the bonds, effectively monetizing the debt through inflation. This option is unpleasant and has costs, but it means the US government can always service its dollar-denominated debt. The worst outcome is inflation, not default in the conventional sense. When a developing country government issues debt in US dollars, the typical structure for developing country Eurobonds issued in international capital markets, it is issuing obligations that can only be serviced with dollars. The developing country government does not create dollars. It acquires dollars by exporting goods and services, by attracting foreign investment, or by borrowing more dollars. When its ability to generate dollar revenues falls, because commodity prices decline, because a recession reduces exports, because capital outflows drain dollar reserves, it cannot service its dollar debt by creating more of the currency in which the debt is denominated. The specific mechanism through which this creates the developing country debt trap, a decline in commodity prices, or a global risk-off event, reduces the developing country's dollar earnings and dollar reserve position. Foreign investors, recognizing the increased risk, begin withdrawing dollar capital from the country. The capital withdrawal weakens the local currency against the dollar. Dollar debt service costs rise in local currency terms as the currency weakens. The government must spend more of its local currency-denominated tax revenues to acquire the dollars needed to service the debt. This diverts resources from essential public services. The economic deterioration reduces tax revenues. The spiral continues until the government either defaults or obtains emergency dollar financing from the IMF or bilateral creditors. The China creditor complication, the new dynamic that has changed everything. Here's the specific development that has made the current developing world debt crisis more difficult to resolve than previous episodes: the emergence of China as a major bilateral creditor whose specific institutional characteristics, contractual practices, and policy objectives make the debt restructuring process considerably more complicated. China's Belt and Road Initiative has made China the largest bilateral official creditor to developing countries, having surpassed the traditional official creditors of the Paris Club, the group of developed country governments that historically coordinated debt restructuring for developing countries in total lending to the developing world. This is a dramatic shift in the creditor landscape that has occurred over approximately 20 years. The specific complications that Chinese creditor status introduces into the debt restructuring process. First, opacity. Chinese loans to developing countries are typically structured through Chinese state-owned banks, the Export-Import Bank of China and the China Development Bank, under contracts whose specific terms are frequently not publicly disclosed. The collateral arrangements, the interest rates, the grace periods, the cross-default clauses, the specific contractual provisions that determine how the loan interacts with the broader debt restructuring are often unknown to other creditors, to the IMF, and in some cases to elements of the borrowing government itself. Second, different restructuring philosophy. The Paris Club creditors, the United States, Germany, Japan, France, and other developed country official creditors have developed over decades a specific set of norms and procedures for sovereign debt restructuring that emphasize burden sharing among creditors. Chinese creditors have been reluctant to accept the same haircuts and restructuring terms that Paris Club creditors accept, creating the specific deadlock that has delayed debt restructuring in several African countries. Third, the collateralization issue. Some Chinese infrastructure loans contain specific collateral arrangements, provisions that grant Chinese lenders specific rights to infrastructure assets in the event of default. The specific legal status and enforceability of these arrangements varies, but their existence creates a specific asymmetry between Chinese creditors and other creditors in the restructuring process. The IMF response, the fire station that can't quite put out all the fires. Here's the specific role that the International Monetary Fund plays in the developing world debt crisis, and the specific limitations of that role that make the IMF a necessary but insufficient response to the current scale of the problem. The IMF is the specific multilateral institution designed to provide emergency financial assistance to countries experiencing balance of payments crises, exactly the situations that the developing world debt crisis creates. IMF assistance provides the dollar financing that the distressed country needs to maintain essential imports and stabilize its currency, while undertaking the specific economic adjustment, fiscal consolidation, structural reforms, exchange rate adjustment that is supposed to restore sustainability. The IMF's resources, the quota capital contributed by its 190 member countries, have been expanded multiple times in response to crisis demands, but they remain finite relative to the scale of potential demand. The $1 trillion in IMF lending capacity sounds substantial until it is compared with the specific financing needs of the 40 to 60 countries that may simultaneously require emergency assistance in a severe global financial stress environment. The specific conditionality challenge, IMF assistance, comes with specific policy conditions, the structural adjustment programs that typically require the borrowing country to reduce its fiscal deficit, reform its tax collection, liberalize trade, and undertake specific economic policy changes that the IMF believes are necessary for long-term sustainability. These conditions are economically justified in their general orientation but have specific distributional consequences. The fiscal austerity that restores debt sustainability typically reduces government spending on health, education, and social protection, imposing specific costs on the poorest and most vulnerable populations in the borrowing country. The common framework failure, the specific institutional gap. Here's the specific institutional development that was supposed to improve the developing world debt restructuring process, and that has delivered disappointing results. The G20 Common Framework for Debt Treatment that was established in November 2020 to provide a multilateral mechanism for coordinating debt restructuring for low-income countries. The Common Framework was designed to address the specific coordination problem that the Chinese creditor presence had created, the difficulty of conducting debt restructuring when creditors operate under different norms, different transparency requirements, and different restructuring philosophies. By bringing China, India, and other major emerging market creditors into a common framework alongside the traditional Paris Club creditors, the G20 hoped to create the coordination mechanism that would allow faster, more comprehensive debt restructuring. In practice, the common framework has moved extremely slowly. The specific cases that have been processed under the framework, Zambia, Ethiopia, Ghana, Chad, have taken years of negotiation rather than the months that the scale of the crisis demands. The specific tension between Chinese creditors insisting on specific treatment for their infrastructure loans and Western creditors insisting on comparable burden sharing has produced the specific diplomatic and financial stalemate that has left distressed countries in limbo for years, while their economies deteriorate. Chapter 8. The Central Bank Balance Sheet Explosion. When the lender of last resort becomes the lender of only resort. Here's the chapter that addresses the specific development in the global debt story that has received the most attention in financial media, but the least adequate explanation: the extraordinary expansion of central bank balance sheets since 2008 through quantitative easing programs, and what this expansion means for the global debt question. The central bank balance sheet expansion is the specific mechanism through which the "who does the government owe it to?" question gets its most interesting answer, the answer being, increasingly, the central bank that the government created and that technically operates as its agent. Understanding this mechanism, its limits, and its consequences is essential to understanding the current global debt landscape. The quantitative easing revolution, what central banks actually did. Here's the specific description of quantitative easing: the policy that has transferred enormous quantities of government debt from private sector balance sheets to central bank balance sheets over the past 15 years. Before 2008, central banks managed monetary policy primarily through short-term interest rates, setting the overnight lending rate that banks charged each other for short-term funds, and allowing that rate to influence longer-term rates through the yield curve. The central bank's balance sheet was relatively modest, primarily the currency in circulation, plus the government bonds acquired through normal open market operations. The 2008 financial crisis changed this, when the Federal Reserve reduced its policy rate to zero and the economy still did not recover adequately, the classic liquidity trap scenario where normal interest rate policy loses effectiveness. The Fed implemented the first of its quantitative easing programs. QE involved the Fed purchasing large quantities of longer-term government bonds and mortgage-backed securities by creating new central bank reserves, new money, and using that money to buy the bonds from their current holders. The specific mechanism: the Fed creates $1 billion in new central bank reserves, essentially entries in the Fed's electronic ledger, and uses those reserves to purchase $1 billion of Treasury bonds from a bank. The bank's portfolio now has $1 billion more in reserves and $1 billion less in Treasury bonds. The Treasury bonds are on the Fed's balance sheet. The net effect is that $1 billion of government debt that was previously on private sector balance sheets is now on the central bank's balance sheet, held against the $1 billion of newly created reserves. The Federal Reserve's balance sheet expanded from approximately $900 billion before the 2008 crisis to approximately $8.9 trillion at its peak in 2022, a nearly tenfold expansion driven by 3 rounds of quantitative easing and the emergency asset purchases of the COVID period. The Bank of Japan's balance sheet expanded to exceed 100% of Japanese GDP, the most extraordinary central bank balance sheet expansion in modern history. The European Central Bank's balance sheet expanded from approximately 15% of Eurozone GDP before the financial crisis to over 60% of GDP at its peak. The specific implication: government debt, that the government indirectly owns. Here's the specific implication of central bank quantitative easing for the "who does the government owe money to?" question. The specific accounting that makes central bank-held government debt categorically different from privately held government debt. When the Federal Reserve holds $5 trillion in U.S. Treasury bonds, the U.S. Treasury owes the Federal Reserve $5 trillion in principal and interest. But the Federal Reserve remits its profits, the interest income it receives on those bonds minus operating expenses, to the U.S. Treasury annually. In normal years, this remittance represents a significant positive cash flow from the Fed to the Treasury. In 2021, the Fed remitted approximately $107 billion. The specific implication: the U.S. government pays interest to the Fed, and the Fed gives most of the interest back. The net cost of the $5 trillion in Treasury bonds held by the Fed is approximately the Fed's operating costs, not the full interest payments. The Treasury effectively borrows at the Federal Reserve's operating cost rate, rather than at the market interest rate for the portion of its debt held by the Fed. This is the specific mechanism that makes quantitative easing so attractive to governments facing large debt service costs. It reduces the effective borrowing cost of the debt the central bank holds to near zero. It is also the specific mechanism that makes QE essentially indistinguishable from monetary financing of government deficits. The government creates debt, the central bank buys it with newly created money, the interest flows back to the government. The debt exists on the books, but its effective cost is minimal. The QE reversal. What happens when the central bank tries to unwind? Here's the specific challenge that the reversal of quantitative easing, the quantitative tightening that central banks have been attempting since 2022, creates for the government debt market. When the central bank holds enormous quantities of government bonds on its balance sheet, the private sector holds correspondingly fewer. The private sector has instead the central bank reserves, the money the central bank created to purchase the bonds. When the central bank sells bonds back to the private sector through quantitative tightening, it reverses this. Private sector balance sheets must absorb the bonds, and the central bank reserves that funded the original purchase are extinguished. The specific challenge: the private sector's capacity to absorb large quantities of government bonds is not unlimited. Pension funds, insurance companies, and banks have specific capacity constraints. Regulatory requirements, risk limits, return requirements that limit how much additional government debt they can hold at any given price level. When the central bank starts selling bonds back to the private sector, it is increasing the supply of bonds available for private investors to absorb. More supply at unchanged demand means lower prices. which means higher yields. The QT process is therefore the specific mechanism through which the government's borrowing costs rise as the central bank withdraws its balance sheet support, and this creates the specific fiscal challenge for governments that accumulated large debts during the QE era at the low yields that QE supported, and that are now facing higher refinancing costs as those bonds mature and must be rolled over at market rates without central bank support. Chapter 9. The hidden debt, the obligations that don't appear in the official numbers. Here's the chapter that addresses the specific category of government financial obligations that are even more significant than the official debt numbers in many countries, the unfunded liabilities that represent real commitments to future spending, but that do not appear in the official debt statistics because of the specific accounting conventions that governments use. This hidden debt is, in a meaningful sense, the most consequential component of the long-run government debt problem, the specific obligations that are too large to acknowledge explicitly, but too real to avoid indefinitely, and that represent the specific mechanism through which demographic change translates into fiscal crisis. The pension system liability, the debt that grows every day. Here's the largest and most widespread form of hidden government debt, the unfunded liability in public pension systems that represents the specific difference between the pension benefits that governments have promised and the assets set aside to pay them. Most developed country public pension systems operate on a pay-as-you-go basis. The current workers' contributions fund the current retirees' benefits, rather than individual accounts being pre-funded and invested. This pay-as-you-go structure creates a specific implicit liability, the present value of all future pension payments that the government has committed to, minus the present value of all expected future contributions. That can be many times larger than the official government debt. The United States Social Security system has an unfunded liability, calculated as the present value of projected benefits minus projected revenues over a 75-year horizon of approximately $23 trillion. This liability does not appear in the official U.S. government debt of $34 trillion. Adding it to the official debt would approximately double the government's total. Financial obligations. European countries with more generous public pension systems have even larger unfunded pension liabilities relative to GDP. Germany's public pension system has an implicit liability of approximately 7 trillion euros, roughly twice Germany's annual GDP, that appears nowhere in Germany's official government debt statistics. The specific demographic driver of these liabilities: population aging. As the baby boom generation retires, the ratio of retirees to working-age contributors increases, making the pay-as-you-go system increasingly expensive. The specific metric is the dependency ratio, the number of retirees relative to the number of workers supporting them. In 1960, the United States had approximately 5 workers for every retiree. Today, the ratio is approximately 3 to 1. By 2035, it is projected to approach 2 to 1. The pay-as-you-go pension system that was financially comfortable at 5 to 1 becomes severely strained at 2 to 1. The healthcare liability, the unfunded cost of an aging population. Here's the second major hidden liability: the government commitment to provide healthcare to its citizens, particularly its elderly citizens, at a cost that is both uncertain and escalating faster than economic growth. Medicare, the U.S. government's healthcare program for citizens over 65, has an unfunded liability of approximately $40 trillion over a 75-year horizon. Medicaid, the joint federal-state program covering low-income individuals, adds additional fiscal obligations that are sensitive to healthcare cost inflation and demographic change. The combined unfunded liability of the U.S. federal government's healthcare commitments dwarfs both the official debt and the Social Security unfunded liability. The specific driver of healthcare liability growth is healthcare cost inflation, the specific tendency of medical costs to rise faster than general inflation and faster than economic growth, driven by the combination of technological advancement, demographic aging, and the specific economic dynamics of healthcare markets. A government that commits to providing comprehensive healthcare to its elderly citizens has made a commitment whose cost is difficult to predict and impossible to cap without the politically sensitive decisions about rationing, coverage limits, and benefit reductions that no democratic government voluntarily makes. The infrastructure gap, the debt of deferred maintenance. Here's the third category of hidden government obligation: the infrastructure deficit that represents the specific cost of maintaining public infrastructure that governments have been deferring in order to reduce visible fiscal expenditure. The American Society of Civil Engineers estimates the U.S. infrastructure investment gap, the difference between the infrastructure investment required to maintain current service levels and the actual infrastructure investment being made, at approximately $2.6 trillion over 10 years, bridges that need replacement, water systems that need upgrading, power grids that need modernization, roads that need repair, the specific financial logic of infrastructure deferred maintenance. Every year of deferred maintenance reduces the current year's visible expenditure, but increases the future cost of the maintenance that must eventually be done. The bridge that could be repaired for $10 million today will cost $50 million to replace in 20 years if the repair is deferred. The specific political economy that produces this pattern is obvious. The repair cost appears in the current year's budget and requires finding current year funding, while the replacement cost appears in a future year's budget and is someone else's problem. Chapter 10: The Debt Ceiling Theater, the specific political performance that confuses everyone. Here's the chapter that addresses the specific American political institution that generates more global financial anxiety than perhaps any other ritual in democratic politics: the U.S. debt ceiling and the specific questions about what it is, what it does, and why the country that prints the world's reserve currency repeatedly puts itself through the theater of pretending it might not pay its bills. What the debt ceiling actually is. Here's the specific description of the U.S. debt ceiling, the statutory limit on the total amount of money the federal government is authorized to borrow, and why its existence is both uniquely American and uniquely confusing. The U.S. debt ceiling is a law passed by Congress that sets a specific maximum amount of outstanding federal government debt. When the debt approaches the ceiling, which happens with increasing frequency as deficits accumulate, the Treasury Department must either be authorized by Congress to raise the ceiling or employ specific extraordinary measures, accounting maneuvers, that effectively create temporary, additional borrowing capacity to avoid breaching it. The specific paradox of the debt ceiling: Congress sets both the budget, the decisions about how much the government spends and how much it collects in taxes, and the debt ceiling, the limit on how much the government can borrow to finance the gap between what it spends and what it collects. When Congress passes a budget that creates a deficit, which it has done in virtually every recent year, and simultaneously refuses to raise the debt ceiling that must be raised to finance that deficit, it is in the specific position of having created an obligation it has simultaneously prohibited itself from meeting. This is not a subtle policy nuance. Congress voted to spend the money. The spending creates the debt. Refusing to raise the ceiling does not undo the spending. It simply creates the specific situation where the government has legally committed to both spending the money and not borrowing to finance it, which is mathematically impossible. Why the debt ceiling matters for the global financial system. Here's the specific reason that a purely domestic American political ritual matters for the global financial system. The specific mechanism through which a U.S. debt ceiling breach would transmit financial stress globally. U.S. Treasury bonds are the global financial system's risk-free asset, the benchmark instrument whose yield defines the risk-free rate for every financial calculation made everywhere in the world. A U.S. default, even a technical, temporary default caused by debt ceiling politics rather than genuine fiscal insolvency, would introduce the specific uncertainty about the reliability of the risk-free classification that would permanently change the way every financial institution in the world prices and holds treasury bonds. The specific financial market consequences of a genuine debt ceiling breach. Money market funds that hold treasury bills as their core. Safe assets would face specific questions about the risk of those assets, potentially triggering the run on money market funds that occurred in 2008 when Lehman Brothers' linked commercial paper broke the buck. Repo market functioning, the specific overnight borrowing market that uses treasury bonds as collateral, would be disrupted as questions about the specific legal status of defaulted treasury bonds as acceptable collateral produced uncertainty. Every financial calculation that uses the treasury yield as the risk-free rate would need to incorporate a U.S. credit risk premium that currently doesn't exist, and that would ripple through the valuation of every financial asset globally. Chapter 11, The Future of Global Debt, Where This All Leads. Here's the chapter that asks the specific forward-looking question that all the historical and structural analysis of the previous chapters has been building toward. Where does the global debt trajectory lead, and what are the specific mechanisms through which the current debt accumulation resolves? The answer is not the single clean endpoint that most financial analysis pretends is predictable. It is a specific set of possible trajectories, some more probable than others, some more painful than others, whose specific realization will depend on the policy choices, economic developments, and political decisions of the coming decades. The sustainable scenario: growth outpacing debt. Here's the first and most optimistic resolution scenario, the specific outcome in which economic growth and modest fiscal consolidation combine to produce a gradual decline in debt to GDP ratios over time without crisis. The specific mechanism: if the economy grows faster than the interest rate on the debt, what economists call the R-G condition, the debt to GDP ratio falls automatically even without fiscal surpluses. A country with a 100% debt to GDP ratio, an interest rate of 3%, and an economic growth rate of 4% sees its debt to GDP ratio decline over time, even if it runs a small primary deficit, because the denominator, GDP, is growing faster than the numerator, debt service costs. The post-war United States operated under these favorable conditions for approximately 3 decades. The specific combination of strong economic growth, moderate interest rates, and the gradual improvement of the fiscal position as wartime spending declined produced the reduction in the U.S. debt to GDP ratio from 120% in 1946 to approximately 35% in the early 1980s without a specific debt crisis. The specific question for the current environment: whether the combination of productivity growth from artificial intelligence, demographic change, and the energy transition will produce the real economic growth that would make the favorable R-G condition operate in the coming decades as it did in the post-war decades. The optimistic scenario is specifically dependent on a technological productivity acceleration that offsets the demographic headwinds from aging populations. The financial repression scenario, keeping rates below inflation. Here's the second resolution scenario, the specific policy approach that has historically been used to reduce debt burdens without either explicit default or obvious inflation. The financial repression that keeps interest rates artificially below inflation, slowly eroding the real value of the debt while transferring wealth from savers to the government. Financial repression is the specific policy toolkit that includes interest rate ceilings below market rates, capital controls that prevent savers from moving to higher-yielding assets, mandatory holdings of government bonds by regulated institutions, and inflation modestly above the nominal interest rate on the debt. The combined effect is a persistent negative real interest rate on government debt. The interest rate is lower than the inflation rate, so the real value of the debt shrinks over time even without nominal default. The United States employed financial repression extensively in the decade following World War II. Interest rate ceilings kept rates below the inflation of the post-war adjustment period, and the combination produced the specific erosion of the real debt burden that reduced the debt-to-GDP ratio more rapidly than the nominal figures suggested. The British government similarly employed financial repression to reduce its post-war debt burden. The specific contemporary relevance, the negative real interest rates that persisted throughout the 2000s, when the Federal Reserve maintained near zero nominal rates while inflation ran modestly positive, were a mild version of financial repression that reduced the real debt burden relative to a scenario of positive real rates. The challenge of deliberate financial repression in the current environment is that it requires both below-market nominal rates and modestly positive inflation, conditions that have proven difficult to maintain precisely because the inflation that makes financial repression work tends to become self-sustaining if it exceeds the specific threshold beyond which inflation expectations become unanchored. The debt restructuring scenario, the painful but necessary reset. Here's the third resolution scenario, the specific outcome in which the debt levels are eventually reduced through explicit restructuring rather than through growth or inflation, a scenario that is painful in its short-term consequences, but that has historically been the specific mechanism through which genuinely unsustainable debt levels are resolved. The global debt restructuring scenario at the sovereign level has historically been triggered by the specific combination of a growth shock, a tightening in global financial conditions, and the specific confidence dynamic described in Chapter 6, where the loss of market confidence in a government's ability to service its debt produces the yield increases that make the debt genuinely unserviceable. The specific candidates for debt restructuring in the current environment are concentrated in the developing world. The countries identified in Chapter 7 as currently in debt distress or at high risk. The developed world scenario, the specific situation where a major developed economy undergoes debt restructuring, is less probable but not impossible, and its specific consequences would be far more globally destabilizing than developing country restructurings because of the role that developed country government bonds play as reserve assets and safe havens. The monetary financing scenario, the inflation resolution. At scale, here's the fourth resolution scenario, the specific outcome where excessive debt levels are ultimately resolved through monetization, where central banks create the money to purchase government debt at a scale that produces significant inflation, and the inflation erodes the real value of the debt burden. This scenario is the specific nightmare of central bank independence, the situation where the fiscal pressure on the government is so large that the central bank's independence is compromised either through explicit political pressure or through the specific logic that preventing a government default requires monetary accommodation that the inflation mandate would otherwise prohibit. The historical precedents for this scenario are alarming in their consequences. Weimar Germany in the 1920s, where the specific combination of war reparations, economic weakness, and monetary financing produced hyperinflation, Zimbabwe in the 2000s, Venezuela in the 2010s, Argentina repeatedly throughout its modern economic history. The specific condition that makes this scenario applicable to developed economies, the specific combination of very large debt-to-GDP ratios, rising interest costs from debt rollover, at higher rates, aging demographics that constrain fiscal adjustment, and political environments where the specific constituencies that would bear the cost of fiscal consolidation have sufficient political power to prevent it. Whether any current developed economy meets all of these conditions simultaneously is a specific empirical question, but the directional pressure in most developed economies is toward more rather than fewer of these conditions. Chapter 12, The Honest Answers, revisiting the question with everything we now know. Here's the chapter that returns to the original question. If every country is in debt, who do they all owe the money to? With the full analytical framework developed across the previous 11 chapters and provides the specific, complete, honest answers that the analysis supports. The complete answer to the original question. Here's the specific, comprehensive answer to the question that opened this video, stated plainly and completely, using everything the previous chapters have established. Countries owe their government debt to the following specific categories of creditors, in roughly descending order of importance for most developed economies. Their own central banks, which have purchased government bonds through quantitative easing programs. For the United States, this is approximately $4 trillion to $5 trillion. For Japan, it is the extraordinary figure of approximately half of all outstanding Japanese government bonds. For the Eurozone, it is the trillions of euros in sovereign bonds purchased through the ECB's asset purchase programs. This central bank holding is the specific category of government debt that is most philosophically interesting. The government owes money to an institution it created, which remits its profits back to the government, making the net cost of this debt near zero, but creating the specific inflationary risk of monetary financing. Their own domestic institutional investors in the pension funds, insurance companies, banks, and mutual funds that hold government bonds as part of their investment portfolios. For most developed economies, this domestic institutional holder category represents the largest share of total debt after the central bank, approximately 40% to 50% of total publicly held debt. The specific economic relationship. The government owes money to the institutions that manage the retirement savings, insurance protection, and investment capital of its own citizens. The pension fund is the intermediary, but the ultimate beneficiary of the government's interest payments is the retired worker whose pension the fund services, their own citizens directly through government savings bonds, treasury direct accounts, and similar programs that allow retail investors to purchase government debt directly. This is a smaller fraction of the total, approximately 5% to 10% for most developed economies, but it represents the specific, direct relationship between the government and the individual citizen creditor that democracy makes meaningful. Foreign central banks, through the specific reserve management function described in Chapter 3. For the United States, foreign central bank holdings represent approximately $3.5 trillion, the specific manifestation of the dollar's reserve currency status in bond holdings. For other developed economies, the foreign central bank share is typically smaller but still significant. Foreign private investors, the hedge funds, sovereign wealth funds, foreign pension funds, and institutional investors who hold government bonds as part of their international investment portfolios. This is the most volatile category of creditor demand, the most responsive to yield differentials, currency movements, and risk appetite changes. Bilateral creditors and multilateral institutions, significant primarily for developing economies, where the IMF, World Bank, and bilateral creditors like China's Export-Import Bank represent a meaningful fraction of total external debt. The specific answer for each major economy: here's the specific creditor distribution for the world's major economies, making the abstract analysis concrete by applying it to specific cases. For the United States, approximately $5 trillion to the Federal Reserve, approximately $7 trillion to domestic banks, pension funds, and insurance companies, approximately $4 trillion to U.S. households through mutual funds and direct holdings, approximately $3.5 trillion to foreign central banks, and approximately $7 trillion to other foreign and domestic investors. The United States owes most of its debt to its own financial system and its own central bank. The foreign creditor share, while significant, is the minority of total outstanding debt. For Japan, approximately 50% to the Bank of Japan through its extraordinary yield curve control bond purchases, approximately 30% to Japanese domestic institutions, banks, insurance companies, pension funds, and approximately 20% to foreign investors. Japan owes the overwhelming majority of its debt to its own institutions and its own central bank. The foreign creditor share is unusually small for a developed economy, which is one of the specific reasons Japan can sustain a 260% debt-to-GDP ratio without the kind of market discipline that a high foreign creditor share would impose. For Germany, the ECB holds a significant fraction through its asset purchase programs. German domestic banks and institutional investors hold the majority of the remainder, and foreign investors hold a modest fraction. Germany's AAA credit rating and strong fiscal reputation make it a net creditor in the Eurozone context. Germany's government has a lower debt-to-GDP ratio than most of its Eurozone partners, and German investors are net creditors to the other Eurozone governments through the Target 2 payment system and direct bond holdings. For developing economies in debt distress, the creditor mix is specifically more concentrated in external creditors, bilateral creditors like Chinese state banks, the IMF and World Bank, and foreign private investors who hold Eurobonds. This external creditor concentration is the specific source of the developing world debt vulnerability. Unlike Japan, which owes its debt primarily to itself, a developing economy in distress owes its debt to parties who cannot be influenced through domestic policy and who can enforce their claims through the international legal and financial system. The ultimate answer: money is a relationship. Here's the deepest answer to the original question, the answer that goes beyond the specific creditor categories and addresses the fundamental nature of what government debt is and what it means. Government debt is not ultimately a relationship between a government and a specific creditor in the way that a mortgage is a relationship between a homeowner and a bank. It is a specific expression of the relationship between the present and the future, between the current generation's desire to spend more than it taxes and the future generation's obligation to service the resulting debt. It is a relationship between the government and its citizens, not in the specific legal sense of individual bond contracts, but in the broader sense that government debt represents the accumulated choices of democratic polities to spend today and pay tomorrow, and the tomorrow always arrives. The money that countries owe was created through the specific mechanism of bond issuance and money creation. It circulates through the financial system, serving as collateral, as reserve assets, as investment. It eventually returns to the government through taxation, through inflation, through financial repression, or through restructuring. The wheel turns. The specific creditors change. The pension fund sells its bonds to a foreign investor who sells to a central bank, but the obligation persists until it is discharged through one of the resolution mechanisms described in Chapter 11. The answer to who do countries owe the money to is therefore ultimately to each other, to themselves, to their future selves, to the financial system they have created, and to the institutional arrangements that give their currencies value and their bonds creditworthiness. The web of obligation is genuinely circular. Every creditor is also a debtor, every asset is also a liability, every government bond is simultaneously the government's debt and the financial system's bedrock. Chapter 13. The dollar's exorbitant privilege. Why one country's debt is everyone else's problem. Here's the chapter that addresses the specific asymmetry at the heart of the global debt system. The reason that the United States occupies a categorically different position in the web of global financial obligation than every other country, and why this asymmetry is simultaneously the most important structural feature of the current financial order and the most politically contentious arrangement in global economics. The asymmetry has a name. French Finance Minister Valéry Giscard d'Estaing gave it to us in the 1960s, when he observed that the United States enjoyed what he called an exorbitant privilege, the specific benefit of being the issuer of the world's reserve currency, which allowed the United States to borrow in its own currency at lower rates than any other country, to run persistent current account deficits without the currency crises that would afflict any other country doing the same, and to effectively require the rest of the world to hold dollar assets simply to participate in global trade and finance. Understanding this privilege, what it is, how it works, who pays for it, and whether it is ending, is the specific analytical foundation for understanding the most important geopolitical and financial story of the coming decades. The mechanics of reserve currency status. Why the world holds dollars. Here's the specific mechanism through which the dollar's reserve currency status operates, the precise chain of causation that results in the rest of the world accumulating dollar assets and lending money to the United States at favorable rates. Global trade is predominantly invoiced and settled in US dollars. When a South Korean company buys crude oil from a Saudi Arabian producer, the transaction is almost certainly denominated in dollars, neither party's domestic currency. When an Indonesian exporter sells textiles to a European retailer, the price is likely set in dollars. When a Brazilian company borrows in international capital markets, the debt is typically dollar-denominated. The dollar's role as the primary unit of account for global commerce is not a natural law. It is a specific historical arrangement that emerged from the post-World War II architecture and has proven extraordinarily durable because of the specific network effects that make it self-reinforcing. Because trade is settled in dollars, every country that participates in global trade needs dollars. A country that imports oil must pay dollars. A country whose companies borrow in dollars must service those debts in dollars. A country whose currency comes under pressure needs dollars to defend its exchange rate. The universal need for dollars as the medium of international exchange creates the universal demand for dollar-denominated assets, primarily U.S. Treasury bonds, as the specific vehicle for holding the reserve balances that international trade and finance require. The specific self-reinforcing logic. Because everyone holds dollars, everyone prices things in dollars. Because everything is priced in dollars, everyone needs to hold dollars. The network effect makes it extraordinarily difficult for any alternative reserve currency to achieve critical mass. Even a technically superior alternative would face the specific coordination problem of requiring every participant in the global financial system to simultaneously switch their reserve holdings, their trade invoicing, and their financial contracts from one currency to another. The specific benefits the United States receives. Here's the precise enumeration of the financial advantages that reserve currency status confers on the United States. The specific mechanisms through which the exorbitant privilege translates into concrete economic benefit. The first and most straightforward benefit, lower borrowing costs. Because the rest of the world must hold dollar assets as reserve holdings, not as a yield optimization strategy, but as a structural requirement of participating in global commerce, the demand for U.S. Treasury bonds is higher than it would otherwise be. Higher demand for a fixed supply means lower yields. The specific estimate of how much Lower, economists have calculated the convenience yield on U.S. Treasuries, the premium that dollar-safe assets command relative to what their fundamental credit quality would justify, at approximately 50 to 100 basis points. On $27 trillion in publicly held U.S. debt, a 75 basis point reduction in borrowing costs represents approximately $200 billion per year in interest savings. The United States effectively receives a subsidy of approximately $200 billion annually from the rest of the world simply for providing the reserve asset that the global system requires. The second benefit, the ability to run persistent current account deficits without crisis. A current account deficit means a country is importing more than it exports, consuming more than it produces, and borrowing the difference from the rest of the world. For any other country, a persistent current account deficit produces the specific confidence dynamic described in Chapter 6. Eventually, foreign creditors become concerned about the country's ability to service its external obligations, withdraw capital, the currency depreciates, and the adjustment is forced by market pressure. The United States has run a current account deficit in virtually every year since 1975, a half-century of consuming more than it produces, without experiencing the specific market discipline that would have ended this arrangement for any other country. The reason, the rest of the world must hold dollar assets, and holding dollar assets means lending to the United States. The deficit is automatically financed by the reserve accumulation that global trade requires. The third benefit, seigniorage, the specific revenue that the U.S. government earns from being the issuer of the world's reserve currency. When a foreign central bank holds $100 in U.S. currency, actual dollar bills, it has effectively made an interest-free loan to the United States. The U.S. issued $100 in paper that cost a fraction of a dollar to print in exchange for $100 of real goods and services. The approximately $1 trillion in U.S. currency circulating outside the United States represents approximately $1 trillion in interest-free financing that the United States receives from the rest of the world simply because foreign entities prefer to hold dollars as a store of value. What the rest of the world pays. Here's the specific cost that the reserve currency arrangement imposes on the countries that are not the United States, the precise mechanism through which the exorbitant privilege of the one is funded by the corresponding disadvantage of the many. The countries that accumulate dollar reserves to manage their currencies and participate in global trade are, in the specific financial sense, making low-return investments in U.S. assets that they would not make on pure yield grounds. The Central Bank of South Korea, holding $400 billion in U.S. Treasury bonds at 4%, could, in a world without reserve currency, dynamics, hold those assets in higher-yielding Korean investments or distribute them to Korean citizens. Instead, they are held in dollar assets, providing the specific benefit of exchange rate stability and international liquidity, but at the specific cost of foregone returns. This arrangement has a further specific perversity. The countries that accumulate the largest dollar reserves are typically the developing economies that are most capital scarce, the countries where the marginal return on investment is highest and where the opportunity cost of holding low-yielding foreign reserves is greatest. A developing economy that holds $100 billion in U.S. Treasuries at 4% while domestic investment could yield 10% is effectively transferring $6 billion per year in foregone returns to the United States, in exchange for the specific financial stability benefits that dollar reserves provide. This is the specific economic logic behind the political resentment that the dollar's reserve status generates in much of the developing world, the recognition that the current financial architecture systematically transfers resources from capital-scarce developing economies to the capital-abundant issuer of the reserve currency, the Triffin dilemma, the structural contradiction at the system's core. Here's the specific theoretical problem that economist Robert Triffin identified in 1960, the inherent contradiction in reserve currency status that makes the current dollar-centered system structurally unstable in the long run, regardless of American policy choices. The Triffin dilemma stated precisely, for the rest of the world to accumulate dollar reserves sufficient to support global trade and finance, the United States must run current account deficits, must consistently export more dollars than it imports, which means importing more goods and services than it exports. but persistent current account deficits accumulate as foreign claims on the United States. The dollar liabilities that back the world's dollar reserves. As these dollar liabilities grow relative to the U.S. gold reserves that originally backed them, or, in the post-gold standard era, relative to the productive capacity and creditworthiness of the U.S. economy, the credibility of the reserve asset is gradually eroded. The world needs more dollars to function, but more dollars means more U.S. debt, and more U.S. debt eventually means questions about the sustainability of the arrangement. Triffin identified this dilemma in the context of the Bretton Woods gold-backed dollar system, and his specific prediction that the dollar's reserve role would eventually create an irreconcilable conflict between domestic U.S. financial stability and the international monetary system's need for dollar liquidity, proved correct when Nixon ended gold convertibility in 1971. The post-1971 fiat dollar system resolved the immediate gold constraint but not the underlying Triffin dilemma. The world still needs dollars to function, the U.S. must still run deficits to supply them, and the accumulation of dollar liabilities still eventually raises questions about the arrangement's sustainability. The current manifestation of the Triffin dilemma, U.S. government debt now exceeds $34 trillion, much of it held abroad as reserve assets. The U.S. current account deficit persists at approximately $700 billion to $1 trillion annually, adding to foreign dollar claims each year. The question is not whether this trajectory is sustainable forever. It demonstrably is not, but specifically when and through what mechanism the adjustment occurs. The challengers. Why displacing the dollar is harder than it sounds. Here's the specific assessment of the various arrangements that have been proposed or are developing as potential alternatives to dollar reserve dominance, and the specific reasons that each faces challenges that make the dollar's displacement slower and more difficult than the challengers advocates typically acknowledge. The euro was the most serious challenger to emerge since the dollar replaced sterling as the dominant reserve currency following World War II. A currency backed by the combined economic weight of the eurozone, the world's largest single market, with deep financial markets and strong institutional credibility, should, in theory, have achieved a reserve share commensurate with eurozone economic size. It has not. The euro's reserve share has remained stubbornly in the 20% range despite the eurozone's economic significance, for the specific reason that the eurozone lacks the specific institutional infrastructure that reserve currency status requires: a single, unified, deep market in eurozone sovereign bonds. The fragmentation of eurozone sovereign debt into 17 different national bond markets, each with different credit risk, different liquidity, and different institutional status, prevents any single eurozone sovereign bond from performing the specific functions that U.S. Treasury bonds perform as the global reserve asset. The Chinese renminbi is the second significant challenger, backed by the world's second largest economy, the world's largest trading nation, and the determined Chinese government policy of internationalizing the currency. China's Belt and Road Initiative, its bilateral swap agreements with dozens of central banks, and its development of alternative payment systems are specific tools of renminbi internationalization, but the renminbi faces the specific obstacle of capital controls. China maintains restrictions on the free movement of capital in and out of the country that prevent the renminbi from achieving the liquidity and accessibility that reserve currency status requires. A reserve asset must be freely available to all participants at all times, and China's capital controls specifically prevent this universal accessibility. The deeper obstacle to renminbi reserve status. The specific trust problem. Reserve currency status requires that holders be confident they can access their reserves when they need them, that the rules governing the asset will not change arbitrarily, and that the legal system backing the asset is independent and reliable. These requirements point toward the specific institutional infrastructure, independent central bank, rule of law, deep and open capital markets, transparent fiscal accounts, that took the United States a century to build, and that China has not yet developed to the standard that reserve asset management requires. The gold revival proposal, the suggestion that a return to gold-backed currency would provide the specific discipline on government borrowing that the current fiat system lacks, faces the specific practical obstacle that the global gold stock is far too small to support the volume of global trade and finance at any politically acceptable gold price, total above ground. Gold is approximately 200,000 tons with a market value of approximately $12 trillion, less than half of U.S. government debt alone, and a tiny fraction of the $300 trillion in global financial claims that would theoretically require gold backing. The cryptocurrency proposal that a decentralized digital currency could replace the dollar as the reserve asset faces the specific challenges of extreme volatility, limited liquidity, uncertain regulatory status, and the fundamental problem that a reserve asset must have a sovereign backer whose productive capacity and legal system give the asset its ultimate value. The slow erosion. What actually happens to reserve currencies? Here's the specific historical pattern through which reserve currency status changes, not through dramatic sudden displacement, but through the gradual erosion that accompanies the relative decline of the reserve currency issuer's economic and geopolitical weight. Sterling's displacement by the dollar is the specific historical precedent that most clearly illustrates this pattern. Sterling was the world's primary reserve currency throughout the 19th century and into the early 20th, backed by Britain's dominant position in global trade, the depth of London's financial markets, and the specific institutional credibility of the Bank of England. Sterling's displacement by the dollar was a process that took decades, beginning with the United States' emergence as the world's largest economy before World War I and culminating in the specific post-World War II institutional arrangements of Bretton Woods that formally enshrined the dollar's primacy. The specific mechanism of sterling's erosion, as Britain's economic weight in the global system declined relative to the United States, the specific advantages of holding sterling, the deep markets, the global trade network, the institutional credibility, became relatively less compelling. Countries that needed to hold reserves had an increasingly attractive alternative. The transition was gradual, punctuated by specific crises: the 1931 sterling crisis, the 1967 devaluation, the 1976 IMF bailout, that each accelerated the erosion of confidence. But the displacement took approximately 5 decades from the moment it became inevitable to the moment it was complete. The specific implication for the current dollar system: if the dollar's reserve dominance is eroding, a proposition supported by the gradual decline in the dollar's share of global reserves from approximately 73% in 2000 to approximately 58% today. The erosion is likely to be similarly gradual, not a sudden collapse, but a slow diversification, driven by the accumulation of specific grievances, the use of dollar sanctions as a geopolitical weapon, the specific concerns about U.S. fiscal sustainability, the gradual development of alternative payment and settlement systems that cumulatively make holding dollar reserves less universally attractive than they once were. The weaponization problem, when the reserve currency becomes a tool of coercion. Here's the specific recent development that has most meaningfully accelerated the erosion of dollar reserve dominance: the United States' deliberate use of dollar financial infrastructure as a tool of geopolitical coercion, and the specific signal this sends to every country that holds dollar reserves. The freezing of approximately $300 billion in Russian central bank reserves following Russia's invasion of Ukraine in February 2022 was the specific event that concentrated the minds of finance ministers and central bankers around the world on a question they had previously been able to treat as theoretical: what does it mean to hold reserves in an asset that the issuing country can unilaterally freeze? The specific logic of reserve holding had always assumed that reserves were genuinely accessible, that the Central Bank of Indonesia or Brazil, or Saudi Arabia that held U.S. treasuries could sell them and receive the proceeds at any time for any reason without restriction. The Russian reserve freeze demonstrated that this assumption had a specific condition attached to it: the reserves were accessible as long as the United States was not in sufficiently severe geopolitical conflict with the holder. For countries whose relationship with the United States was not guaranteed to remain favorable indefinitely, a category that includes almost every non-NATO country, the Russian precedent introduced a specific credit risk into dollar reserve holdings that had not previously existed. The consequence has been the specific acceleration of reserve diversification that the dollar's share statistics reflect: a faster accumulation of gold reserves by central banks that want an asset no government can freeze, a greater interest in bilateral currency arrangements that bypass dollar settlement, and a more serious exploration of alternative reserve assets than was occurring before February 2022. The specific irony: the United States' use of dollar weaponization as a geopolitical tool is simultaneously its most powerful short-term coercive instrument and its most significant long-term threat to the reserve currency status that makes that instrument powerful. Each use of dollar sanctions provides a specific demonstration of the instrument's effectiveness, and a specific incentive for every country watching to reduce its dependence on the instrument that could be turned against it. Where this leaves the global debt system. Here's the specific implication of everything in this chapter for the global debt question that the entire video has been building toward. The dollar's reserve currency status is not merely a financial arrangement. It is the specific institutional foundation that makes the current global debt system function in the way that chapters 1 through 12 have described. The reason that the United States can sustain $34 trillion in government debt without the confidence crisis that would destroy a smaller country is specifically because the rest of the world must hold dollar assets to participate in global commerce, creating a structural demand for U.S. treasuries that exists independently of whether they are attractive on pure yield terms. If the dollar's reserve role erodes significantly, if the dollar's share of global reserves continues declining from 58% toward the 40% to 45% range that some projections suggest is plausible over the coming decades, the specific consequences for U.S. government borrowing costs would be meaningful. The $200 billion annual interest rate subsidy that reserve status provides would shrink. The structural demand for treasuries from foreign central bank reserve accumulation would decline. The U.S. would face more of the market discipline that other countries face when they run large fiscal deficits. This is not a crisis scenario. It is a gradual adjustment scenario. The slow erosion of a privilege that was never permanent and that is now, for the specific combination of reasons described in this chapter, becoming somewhat less exorbitant than it once was. The web of global debt obligation that this entire video has described is therefore not static. It was built by specific historical choices: Bretton Woods, the Nixon shock, the specific post-war institutional arrangements. It is being challenged by specific contemporary developments: the rise of China, the weaponization of dollar finance, the Triffin dilemma's slow, grinding logic. And it will be reshaped by the specific policy choices, geopolitical developments, and economic dynamics of the coming decades. The dollar will not suddenly cease to be the world's primary reserve currency. The web of global debt will not collapse tomorrow. But the specific architecture of who owes what to whom, which this video has spent 12 chapters carefully describing is in the early stages of a transformation whose ultimate destination is not yet determined. The web is rewoven slowly, thread by thread, dollar by dollar, reserve decision by reserve decision, but it is being rewoven. Conclusion. Let's bring the full picture into focus. You came to this video with a question that sounds simple but turns out to be one of the most sophisticated questions available in economics. If every country is in debt, who do they all owe the money to? The answer, fully assembled from all the chapters that preceded this conclusion, is this. They owe it to their own central banks, the institutions they created to manage their monetary systems, which have purchased trillions of dollars of government debt through quantitative easing programs, creating the specific circular arrangement where the government pays interest to itself through the central bank profit remittance mechanism. They owe it to their own financial systems and the pension funds, insurance companies, banks, and investment funds that hold government bonds as the foundation of their investment portfolios, managing the savings of the citizens in whose retirement security and insurance protection the government's creditworthiness is directly embedded. They owe it to each other. The specific web of cross-border financial holdings where Japan holds U.S. treasuries and the U.S. has investments in Japan, where Germany is a creditor to Southern Europe, and Southern European capital is invested in German assets, where every major economy is simultaneously a creditor and a debtor in a web of mutual financial obligation that has been deliberately constructed to create the interdependencies that make financial cooperation more rational than financial confrontation. They owe it to their own citizens, directly through savings bonds and treasury accounts, and indirectly through every financial intermediary that manages citizens' savings and invests a portion in government debt. And developing countries owe a significant fraction to external creditors, Chinese state banks, Western bilateral creditors, the IMF and World Bank, and private foreign investors in the specific foreign currency debt that creates the vulnerability that makes developing country debt crises categorically more dangerous than developed economy debt accumulation. The global debt system is not a pyramid with a single creditor at the top collecting payments from the world's governments. It is a web, extraordinarily complex, deeply interconnected, simultaneously circular and asymmetric in specific pairwise relationships that has been built over decades of financial innovation, geopolitical arrangement, and the specific political economy of democratic governments that find borrowing easier than taxing. The web works as long as confidence in its constituent elements is maintained, as long as governments service their debts, central banks, maintain their credibility, and the specific financial relationships that circulate the debt through the system continue to function. When specific threads in the web are pulled too hard, through unsustainable fiscal trajectories, through the collapse of confidence that debt crisis mechanism describes, through the specific shock of a major creditor withdrawing, the consequences propagate through the connected web in ways that affect every participant. The specific reason this matters for you, regardless of whether you have ever bought a government bond or thought about sovereign debt before this video, every interest rate you pay, every bank deposit you hold, every pension you will eventually receive, every piece of infrastructure you use, and every currency in your wallet is part of this web. The government debt system is not an abstraction that financial analysts discuss in conference rooms. It is the specific financial infrastructure of the world you live in, and understanding it is the specific intellectual foundation for understanding every major economic story of your lifetime. The question everyone asks at 2 a.m., who does everyone owe all this money to, turns out to have the most interesting possible answer, mostly to each other. And the web they've woven is the world.